Hey guys, welcome back. So in today's video, we're going to be taking a look at the Disney Corporation. And ironically, we're going to be taking a look at the Disney Corporation through a very cynic lens. And it's kind of weird that I say cynical and Disney kind of hand in hand. At least for me personally, Disney has always been a company that really touches upon me, especially my childhood. And I think most people's childhood really revolved around Disney and a lot of the movies, the shows, and everything that is involved with the Disney company. But I'm taking a look at it now, looking at how it's been acting over the past few weeks in relation to the overall stock market, how it's dealing with what's going on the, the whole macro global environment right now, and the stock price has been kind of showing some worrying signs. Now, the stock price, does not necessarily, the stock price does not equal reality. So, right now, the stock price being relatively depressed compared to the overall stock market is either a telling sign on the future that is to be kind of in store for Disney, or it could be a compelling price discovery play, and it could be an amazing company that has a very long track record of growth, trading at a very attractive valuation. So I'm going to be taking a look at that. I'm going to be sharing some of my findings with you that I've kind of been going over the past few days, and a couple of the things are pretty interesting to me, and it also kind of poses a couple of questions in my mind. Mainly boiling it down to, is Disney right now trading at a bargain valuation, about 30% down from its all-time high? Or, and it is really weird to say this, is the Disney Corporation, facing bankruptcy in the face? And that's something I still, to this day, don't fully feel like should be a sentence. I feel like if I say that the Disney Corporation is going to be going out and going away, I cannot envision a world without the Disney Corporation. But there is an argument to be made that the Disney company might not make it through the recession. So I'm going to get into that in just a bit. Hopefully you guys enjoy some of this content. Let me know what you guys think. Let me know what you think about Disney right now before you hear my, kind of thoughts on what I found. And I want to see if your thoughts change by the end of the video, because to me personally, I really cannot, even looking at the numbers and thinking about the bear case, I really cannot see a world without the Disney Corporation. So it's almost weird for me to even say half of this video. So it'll be interesting to see what you guys think in the comment section down below. But anyways, let's get in the video. So just to take a look at what is going on with the company right now. So the stock price is down roughly 33% from its all-time high, and it's actually underperforming the overall stock market in recent weeks. And it's interesting for me to see that. At face value, you see one of the oldest companies in America, one of the most consistent companies, owns so many brands. They've been rapidly growing over the past few years, and it is underperforming the overall stock market. And you'd think, looking at it, like, okay, this is a generic blue chip company. It should be overall safer than the average company in the market, right? Well, taking a little bit of a closer look at what's going on, the really tragic tale, ironic, of Disney is that they made an extremely important and extremely impactful bet at seemingly the worst possible time. Now, obviously, I'm going to be referring to the acquisition of Fox, but there are little other tidbits going on right now under the scenes at Disney that I think are really worrying to a lot of long-term investors. And I also want to kind of point these out because I think the average person that is looking for a bargain right now, and the average person that's getting into that FOMO type of hysteria, they think, okay, the stock market was down, 30 extra percent just a month ago. Did I miss it? I'm looking for all these great companies. Oh, Disney is still kind of suppressed. I better throw my money in right now because it's going to go up with the rest of the market soon. And I don't think that you can just play the game like that, but I have a feeling a lot of retail investors are, judging from the trends I see on the Robinhood app, and also from just search terms and everything like that, and then also my fellow classmates talking about the Disney company. I think people are assuming Disney will be fine no matter what, and they're writing off some key major issues that the company is facing. Now, so looking at the company, doing a quick breakdown, because the company breaks their revenue down into roughly 4 segments. They have their parks, their experiences, and then all their other products, and that equates to roughly 36% or so of their overall revenue, at least of 2019. Then you have the media networks, so this is all like their actual broadcasting and everything like that, and that equates for roughly 34% of their overall revenue. And now the studio entertainment is roughly 15%, and then finally the direct to consumer, so you can think about like games, apps, and all that stuff, like little consumable things that they're just kind of pumping recently. That's roughly 13% of their overall revenue. Now, so to take a quick look at the company on a top level view, the company gets its revenue from roughly 4 major businesses. Those are, and then with a rough estimate of the percentage of each of those breakdowns, you have the parks, the experience, and products segment. So, think about like Disneyland, the cruises, and everything like that. That's roughly 36% of the company's revenue. Then you have their media networks. That equates to roughly 34% of their overall revenue. Their studio entertainment, and that goes to about 15% of their overall revenue. And then the direct consumer line is roughly 13% of their overall revenue. Now, when you look at that, and you look at those market segments, there's a couple of worrying things right now, especially with what's going on in the particular type of crisis we're dealing with right now. Almost all Disneylands are closed. All the cruise lines are closed. And that is the biggest chunk of their revenue right now, is from those experience attractions that require people going out to very densely populated areas from all over the world, spending gobs of money, spending 1,000 nights in a hotel with all these fancy meals. And that was their big ticket item and has been for the past few years. And essentially that's going to be going to zero. So when you look at that, that's roughly 36% of the company's revenue goes to immediately zero. Then taking a look at other things, when you look at their media networks and their entertainment area, how many people are going to the movies right now? What movie theaters are still open that people can go? And even if movie theaters in some areas of say, the United States or other parts of the world are still open, how many people are like gung-ho trying to take a family adventure right now to go watch a classic Disney movie? I would wager not many. So the company has the ability to lose overnight anywhere between 36% and about 55% of their total revenue in the blink of an eye. Now, that does not really bode well for a company, any company at all, but particularly Disney, because Disney also, as of last year, just closed their biggest acquisition to date. They bought the Fox Media Company. Now, they bought Fox for $71 billion, depleted a lot of their cash, took on roughly, $36 billion worth of debt, and then diluted their equity and things like that. But they added in $36 billion to their balance sheet, which a year ago didn't seem like a big deal. Most investors were happy that they were able to close that deal. Debt was relatively cheap. Disney was a robust company. They were rolling out Disney Plus. Investors thought, okay, sure, this will just make Disney Plus more attractive. It'll make Disney more of the monopoly of entertainment industry that it already is. Everything will be fine. Cool, they got a decent price on it. Let's just go. But now we are dealing with a company that just saddled up on a lot of debt and now possibly ran out of all of its cash-generating businesses. So what does that really mean? When you're dealing with a market like we're in right now, anything can go wrong, and your due diligence is going to be, I guess, fact-checked very thoroughly in today's environment. You don't really necessarily get to just throw money at random blue chips that are growing and expect to get a good return. Nowadays, when there's economic turmoil, people will be looking for things to sell and get out of to protect their capital. And I'll stop you right there before I get into the debt issue. I know most of you right now are thinking in your head, well, what about Disney Plus? That is kind of the answer to everything. They made a streaming service right before this happened. They got super lucky. They're competing with Netflix, and that's going to keep them afloat, right? Not quite. So Disney Plus, yes, is growing very quickly in these conditions with everybody being at home. They added 29 million subscribers just in a couple of weeks of this whole issue starting. But the thing that you need to read is that Disney Plus, yes, it's generating $4 billion in revenue now, but the loss is roughly $700 million. So when you look at that, Disney Plus is great. It's getting Disney's name out there. People, the end consumer likes it because they're buying, for $6-7, they're buying a pretty good entertainment suite. But it's a loss-generating business for Disney. Disney is only doing it to essentially slow Netflix's growth. They don't really care too much about the profits, or at least they didn't when they launched it. The profits coming from Disney Plus not yet. Hence why they were able to have it at such an attractive price. And so now Disney's faced with the fact that they kind of bit off a little bit more than they can chew on the Disney Plus front, and Disney Plus might actually become a negative rather than a positive for the company going through all this. And so that's just something to keep in mind, and that don't just assume, because this has been the topic of discussion a couple of times when I've spoken to people about Disney. Don't just assume that because Disney Plus came in at a convenient time in terms for a consumer, that it necessarily means it was a good idea for the business at that point in time. And again, this kind of goes into the tragic tale of Disney, that they seem to have made really bad bets at the worst possible moments. And now to wrap up this video, I'm going to be doing my little napkin math for you guys, so you guys can kind of see what I'm worried about for the company, and my overall thoughts on the company, and then you guys can go on to Disney's actual financials and come to your own conclusion. But what I see right now, Disney for last year made roughly $75 billion in revenue. Okay, their EBIT was roughly 15% of that, and so the reason why I'm doing that is because when we're going to be affecting the top line, and we're worried about the growth that they're going to be experiencing, or the negative growth that they're going to be experiencing, and then the amount of debt they're going to be doing, in the foreseeable future, kind of like what I talked about with Starbucks, is you need to understand that that debt needs to be covered first before anything else. Otherwise, the company goes bankrupt. And with only a 15%, say, EBIT margin, anything that happens to the top line exacerbately affects their bottom line. So taking just some numbers here, so you guys, I'll put them up here on the board. So roughly it made $75 billion in top line. EBIT's roughly 15% of that. Assuming we have, say, a 50% drop in revenue, keep in mind that's probably not too far off in my opinion, with one of their business entities going completely out the window, Disney Plus growing at a very fast rate, and their loss is widening at a pretty substantial clip, about a 23% clip, I believe. And their overall movie revenue is going to the floor. So I think roughly 50% of a revenue loss for Disney isn't too unheard of, at least in the short term. And so that's going to bring down their EBIT to roughly $3 billion. Now, looking at that, okay, yeah, it's still making $3 billion, but then look at the amount of debt that they just came up with. And I'm looking at this debt, I'm looking at their debt payments from their most recent 10Q, and that was for roughly $283 million. Now, I'm going to multiply that by 4, assuming that Disney loses 50% of their revenue over the next year, and that they have roughly the same amount of debt for the next few quarters, because none of those debts are due within a year. And they're going to have, say, a bill payment for just their debts of about $1.13 billion during this time frame. So their interest coverage ratio goes from what it was prior to this whole catastrophe of being between a 10 and a 12, all the way down to a 2.6. Now, this is worrisome. This is not a financial stable position that a company like Disney would want to be in, especially because a 50% drawdown is, in my opinion, what is the most probable. It does not mean that it can't go worse. And if it goes down worse, say if it drops by about 80% on a really worst case scenario, Disney will run out of money very quickly. And then Disney will have to scramble together to get more debt out. They'll have to, sell off businesses for pennies on the dollar. Things can bode horribly for Disney very quickly in this environment. So that's just kind of the quick looking at just the company's liquidity right now. And then you take a look at the company's Altman Z-score. Now, the Z-score, for those of you that have not taken high-level finance classes, this is essentially a quick little tool that isn't perfect, but it's more or less effective in just looking at the financial risk a company has in facing bankruptcy. Now, anything above a 3, the company is considered to be relatively safe, and anything below a 2 is, cause for concern. Anything below a 1 is like, yeesh, this thing's probably going under. And right now, if you just look it up on Google Focus or anything, you get a Z-score of Disney of roughly a 1.9. So what that means is that the company is already in financial distress before any of these new numbers coming out from, this economic recession that we're going to be going into. So a company that was in financial distress now plunged into a very, for them particularly, a very damaging recession. It really is weird to say this, but I am more, if I were to make a bet, without a bailout, I think Disney would face bankruptcy. I think that there is a good chance that this issue, lasts longer than people are expecting, and say it lasts longer than a year. And if it does, Disney can very quickly run out of cash, and Disney will have to start making drastic choices. Now, Disney can obviously sell a lot of their franchises, raise money to private equity, all that. Yeah, I definitely think that before Disney, would go down with the ship, they would definitely, really downsize as a company. Um, but I don't see a scenario where they make it out of this recession unscathed, and I think the market has the same conclusion. And so I personally am going to avoid, for right now, with its current price and valuation, avoid taking that contrarian bet. I do not think that Disney right now has a good asymmetric risk reward, and I think that a lot of people that are buying Disney at these levels are a little too optimistic, in my opinion. So that's my overall takeaway from the company. If it continues to go down lower, maybe I'll revisit it, but for right now, I'm staying away, and I don't think I'll be adding to it anytime soon. So that's my overall takeaway from it. Let me know what you guys think in the comment section down below, and then let me know if you actually like this type of analysis. It's just kind of a cool way for me to look at a company, give you guys kind of, just the raw meat and potato takeaway, and then me actually not have to just show you a wall of Excel spreadsheets in how I analyze companies. So let me know if you guys like this top level view, and I will catch you guys in the next video. Peace.